It's a pleasure to be here with you guys. Today I have Matt Kaufman, and I must say it's been difficult to actually book this. First, because I am on holidays, and I'm still am, and Matt is going on holidays in just a few hours. But topic is so interesting that I actually just took 2 hours just to speak with Matt about this. So just so people who do not know Matt is global head of ETFs at Calamos Investments. I know him from his time at Milliman, where he was president of the broker-dealer of the Milliman Investment Management Services, a lot of IP that Milliman did. And again, for the people who don't know Milliman, how would you explain Milliman for someone which doesn't know anything about US or at least Chicago?
Sure. Yeah, Milliman is a global actuarial consulting firm would be the proper term for Milliman. We had a financial risk management group whose job was to hedge out balance sheets for large life insurance companies. So yeah, as you could make those corollaries into bank balance sheets as well, there was a lot of work on the structuring side and futures and
And I
options.
think that's interesting, right? Because, our main audience is advisors, and I think it's quite interesting to talk about Milliman, right? Because you, on the derivative sides, let's say, or the structured products or structuring investment solutions, right? You are not the person that advisors talk about. Milliman is and it was on the background of the hedging of the derivatives risk. How would you explain like the derivatives risk management when it comes to the FIA? So who doesn't know FIA is fixed income annuities, structured annuities, and so on.
Yeah, in the United States, you can make a curve and you've got fixed indexed annuities on the bottom left. I'm in a mirror here, bottom left, and that will give you 100% protection. The tagline there is zero is your hero, and then you're tied usually to some lower volatility version of a broad equity market. All the way on the other side, you've got leveraged exposure. The variable annuity will give you tax deferred growth, but lets you choose from a number of investments. And then, right in the middle is the principal protected, the buffered strategy, which gives you partial principal protection. That, really came about during the zero rate environment. Probably don't have to, go into that explanation for your listeners. I'm sure they're quite aware of all of that. And then, the bigger space that we're seeing today is the auto call. The derivative income space is exploding. In the ETF market, it's covered calls. In the structured market, it's auto calls.
Now, Matt, look, we talked in the past, right, about the buffered ETFs, which has been growing a lot. I think we have the two of us, we have different views about them, but tell me
Is it you and I do, you're saying?
we have definitely different views, which we'll discuss here. But what does it take the launch of the first US auto-callable ETF? Is that an evolution of derivative structured products as well as the buffered ETF space?
Sure. Yeah, I don't know how much time your listeners will be willing to give us here, but if you go back to the zero rate environment that we were in post global financial crisis, that zero rate environment really drove a lot of innovation in structured products and in insurance products. You couldn't really give someone good principal protection with rates at zero, and you couldn't give someone good guarantees on their variable annuities in that rate environment either. And so it forced the insurance space into a risk sharing model where rather than principal protection, they'd give somebody something less. They could give you a 10% buffer, 20% buffer. Well, that was all index based. And, at Milliman, we were largely dynamic hedging. A lot of active management went into that. And so those were all index products. We didn't have a whole lot of business in that. And so what we concluded, what we found is you could deliver a buffer and a cap on the S&P 500 way more efficiently with options than you could with a balance sheet. And so that's what we delivered into the United States. We built some IP that used flex options on large liquid underlyings like the S&P 500, NASDAQ, Russell. And then we built that structure using options, and we delivered it into the market through some unit trusts, through some variable annuity providers, and then through an ETF provider as well. That kind of set the stage for the buffered or defined outcome ETF space that we have today. The holy grail, the one that has not been done before, is the auto-callable market. There's a listed space for auto calls. You can't do a deep 40% long-term barrier with a call feature. Like, those do not exist on any listed markets. And so to deliver that efficiently into the market, it requires a partnership. It requires working with an index provider, requires working with a bank. And so that's what we did. What we did with the buffers, 9, 10 years ago was good. But as we innovate and as we expand into other categories and build new types of offerings, what we did with the AutoCall ETF was we partnered, or I would say collaborated. JP's compliance department doesn't like the word partner, so we'll say collaborate. So we collaborated with JP Morgan and Mercube, which is a big custom index provider. The CEO of Mercube used to be at Standard & Poor's and started Mercube. Does a lot of indexing on the structuring side. So the three of us came together and built out this construct for delivering auto-callable exposure into the ETF wrapper. We built one new index, and then there was one that already existed. So we can kind of map that out. So we built a laddered index that provided laddered exposure to synthetic auto-callables. We're not going out and purchasing actual auto-callable notes from any bank, but we can replicate the payoff of that. And then we delivered that inside of a laddered index, and then you can trade that index on swap. So
Yeah.
go ahead. I'll stop there.
Let's talk about these two things, right? Because for me, they're very important for people to understand. One, of course, is the autocallables, right? And again, I speak a lot about autocallables. Are within structured products, they're one of my favorite ones.
Me too.
Besides the specific ones. And for me, the knowing exactly your payoff, how much is going to be your income, it's very, very, very attractive, right? Especially for people who want to understand their risk and the potential return. Why did he decide to go for the autocallables? And then the second question, right, is why ETFs? Because you work a lot on the annuity space, also on the ETF space, and people JP Morgan, Mercube, they work a lot on the securitized space. So yeah, maybe you can tell us why autocallables. Why do you really think that's a differentiator from all the other buffered ETFs? I mean, now everyone thinks that they can do a buffered ETFs.
Yeah.
So you can tell me why you decided. Yes.
That's right. Yeah, my framework is in the U.S., and in the U.S. the ETF is by and large taking a lion's share of the assets. It's tax efficient, it's liquid, it's transparent. Relative to a note, there's no K1 forms in the States. You get K1s, which is a different tax document. Here it flows through your 1099 statement. So there's remarkable efficiencies for delivering it inside the ETF wrapper. And as you've probably seen, just about every asset manager is thinking through their ETF strategy. And so that is the wrapper of choice for a lot of people right now. It's the way a lot of advisors' books are built, is to lend themselves to use ETFs. So the other question that you said was about why auto calls. If you follow the derivative income ETF market, it's exploding. I helped build the first covered call ETF at PowerShares back in 2008. No one bought it. No one knew what a covered call was back then. At least in the ETF world, they were busy with S&P and NASDAQ exposures. Fast forward to 2025, and the covered call space in ETFs is over $115 billion in assets. And, it's largely dominated by JEP-E and JEP-Q, large covered call strategies. As you know, when you go into the structured note market, the auto call dominates derivative income. That derivative income category is still king, but it's dominated by the auto call. The ability to deliver a high coupon and have a deep in the money barrier and have principal protection built in, returning your money at par so long as those barriers don't break. I think that the structured note market has spoken, and they like the auto call better than the covered call. So bringing that space into ETFs, we've opened up a whole new world, a whole new category to the ETF investor in the US. And what we're seeing is there's advisors coming out of the woodwork. They're saying, I shop for auto-callable notes all day long. I buy a few for my clients, I get called away and I have to do it all over again. It's operationally inefficient, it's tax inefficient. And so they're saying, this is what we've been waiting for. This is the easy button for us. But then there's, 95% of the rest of the financial advisory community that says, okay, what is an auto call? And 10 years ago, we had to teach them what a buffer was. Now we have to teach the market what an auto call is.
So let's talk about it. And I mean, this is not an advice, but from your own perspective, how you build the ETF, what type of investor is the product tailored to?
So the ETF that we built, the first iteration, if there's a flag to plant, it's the question is, okay, which one do we do first? And what we built was that laddered index. Each of the underlying auto calls is tied to the Mercube US Large Cap Vol Advantage Index. It has about 3 billion in assets already tied to JP Morgan auto-callable notes. And so we thought that was a great place to start. Why not build toward the front of the innovation curve? A lot of folks are looking at worst of baskets and tying themselves to those. Well, you know what happens when those correlations go to one. Your coupon rates change all the time. There's volatility in those coupons. When you have a vol advantage index, you can stabilize the volatility, stabilize the dividends, and now you've got a very stable coupon. And when you do that 52 or more times, you can diversify out your checkpoints, diversify your maturity risk, your coupon risk. So that's what we built. It has a coupon right now, average weighted coupon of about 14.5% annualized. The experience of the investor is going to look a lot like an equity market. It'll look a lot like the S&P 500, maybe a little more volatility, a little higher beta. So you'll have some discounts, as the market's moving down, you've got mark to market performance, and then, as long as that rubber band doesn't break, you're going to snap back to par. And so that was the first iteration. We're seeing advisors use that for income purposes. They might swap out equity exposure and generate high income. Some people think we're in a more muted environment going forward, and so getting 14.5% was going to outpace the S&P 500. So that might be a way to access that as well. So I think that's the first iteration that we've brought out. But again, I think this is the beginning of a very large space.
And I think it's interesting, right? Because ETFs, especially even with the buffer, the covered call, right? It was always about equity performance plus some small risk premium, right? And autocallables
Right.
are the opposite, right? Autocallables
Exactly.
is stable returns, right? As long markets do not become very volatile, right? And when they're volatile going on the downside, risk goes up massively. Of course, you have all those bid and ask spreads because of the implied volatility, and on the day around you get all that income going in. But I think it's important to talk about the economic aspect of autocallables in ETF versus the traditional notes. What do you think it's important for people to understand? What's the difference between those two main wrappers?
Yeah, when you buy an auto-callable note from a bank, you give your money to the bank. They put that money on their balance sheet. They deliver the terms of that note at the end, either at the end of the life of the note, or you get called away and you get your coupon along the way. The way that we're talking to investors about auto-callables is reframing their mindset. Because right now they're thinking protected growth. They think buffers, and they're like, oh, is this a buffer? It's like, no, this is totally different. Think of this like a bond whose coupon and principal value are tied to the stock market and not credit or duration. So that's how we talk about this to advisors. But if you buy that note from a bank, you can kind of close your eyes and then you get the results. But the blessing and the curse of the ETF wrapper is it's liquid every single day. So the value of your structured product or your auto callable, and you can see that trading in the market. So one of the things that we did on our website is we built a pricing tool. So you can go to, I call it a dashboard. You can go to our website, calamos.com, and you can see where every auto callable is trading, premium, discount relative to the reference asset. Is it paying its coupon? Is it not? How close to the barrier are you? How far away are you? So we give you a tremendous amount of transparency so you can make a decision. Is this a good time to buy in? Is this a bad time? Do I want to hang on to this? If the market's crashing and you see those auto calls start to go down, you're not stuck with the product. You could actually get out if you want. So there's some remarkable liquidity and transparency to the ETF wrapper, going back to my other point.
Yeah, of course, you lose also the funding level, right, of the banks, right? Because again, when you tie to a bank, then they need to pay you for getting that risk, right? But I think it's a very good point about ETF takes care of some of those pain points for advisors and investors, right? So if I have to call you, if I have to ask you, okay, what are the three main points that the Auto-Callable ETF solves versus, let's say, the structured notes Auto-Callables, what do you say would be the top three for you?
Oh, that's a good question. I would say high stable income, transparency, I'd say is number two. And in the United States, it's tax efficiency far and away. So if you buy a auto-callable note in the United States, that income is treated as ordinary income. The way that we are distributing this income, if we pay 14% coupon, a lot of our money is sitting in collateral inside the ETF, and then we trade that swap with JP Morgan. So we have to distribute about 3 percentage points of that as ordinary income. The other 11 distributed tax deferred. So it'll be treated as return of capital, and that will just reduce your cost basis. So if you bought in at 25 and then you sell when you're at 15, you'll pay long-term capital appreciation rates when you sell. Some advisors are using this as, in charitable accounts or for their older clients. They say I can largely generate tax-free income for them. And then when they either pass away or if you donate those shares, the recipient gets a step up in basis, and it's like nothing ever happened.
So it's very important, right, to talk about the challenges because I'm a structured notes person. I've been there for almost 20 years. I guess we're getting old, Matt. But part of it is, of course, hedging this risk, right? Because that was the whole thing of the structured notes, right? The difficult to hedge the risk with ETF with intraday liquidity, right? How difficult it is to hedge the risk and to manage get exposure to investors with the downside protection.
Yeah, if you're familiar with structured products, you'll appreciate the beauty in the structure that we've put together here. We've got the vol control on the underlying reference asset. You have a stable decrement, a stable dividend, which solves a lot of the dividend risk that we're all familiar with as well. And then we've replicated those payoffs. We are not buying actual notes, but we've replicated the pricing of those notes and then compiled all of that into one index, and then we trade that index on swap. It's a single price, the pin of the top of the pyramid. We trade that on swap with JP Morgan. So all they need to do is hedge out their exposure to that single index. And then if you follow that all the way through to the ETF, where you've got to deliver this in a liquid form, yesterday when I checked, we were trading 1 penny wide. Like, where else can you deliver an auto-callable experience? You can't find a bond ETF that's a penny wide. So we've delivered this auto-call experience with a penny wide spread, or at least sometimes it's a penny.
Well, that's impressive because I can tell you, right? I see the bid ask and spreads because unique structure nodes, the spreads are much higher. Now, of course, we can talk about all the autocallables ETF forever. I've wrote extensively about autocallables. I love them. I also understand the risk. Future, another type of, let's say, more exotic options that structured nodes have been putting there. I mean, callable features, more barriers, credit components inside ETFs. Is that something that you think that that's going to be the next step?
The adoption curve that we see, at least in the United States, is the way that I put it is it takes 1,000 days for somebody to understand and catch on, for the market to learn what you've done. It was that way with smart beta ETFs, 20 years ago. It was that way with options-based ETFs. You start to see the adoption curve. Buffers were similar. Very few people understood buffers. What we did with the buffers is we took all the registered insurance agents in the United States. There's about 1.2 million of them. And then we found which ones were dual registered as a registered investment advisor. And that filters through to about 5,000. It's a very low number. And that's your low hanging fruit. That was our target that we went after first. And those folks got it. They said, okay, I know what you're doing over here. Now I can buy it on this side of the house. So that process has been similar. We want to find those advisors who are already using auto calls. This gives them a seamless way to implement that inside a portfolio. If you allow me a fourth bullet, I'd say model portfolio ready. This is a single ticket. You can add it to your models. You don't have to move in and out or find the right ones at different times. It's just a one ticker solution. But again, back to your comment, we put a flag in the ground on the auto callable space. We can do it in ETF form now, and I think there's going to be a big demand for this going forward. And then as that demand grows, we want to teach people the common denominators of auto calls, and then as they get up to speed, you'll obviously start to see innovation there.
So let's talk about, right, because buffered ETFs, right? Massive expansion, last 10 years have been amazing.
Hmm.
Growth, right? They're performing relatively well, right? Difficult with COVID and with the volatility of changes, but overall, they perform very well in the long term. So, what's going to be the explanation, trying to understand what's the difference between your auto-callable ETF and the buffered ETFs?
Yeah, I try to at all times explain that this is not a buffer. A buffer is a structured note, but a structured note is not always a buffer. And so you can buy a buffered note, you can buy a income note, you can buy a growth note, enhanced. There's all kinds of structured products. What we have done is we've built the auto callable. We've brought the auto callable space. So this is an entirely new category. I think we will do a disservice to the market if we try to make that connection and that corollary, because it's a remarkably different type of solution. One is a protected growth vehicle. The other is high stable income that's tied to deep tail risk. The other gets rid of your tail risk. Here you're taking on tail risk for a coupon payment. So we want to make sure that investors understand what they're taking on in order to get that coupon. You're taking on deep tail risk, equity market tail risk in exchange for that coupon. Most people are comfortable with that. They say, well, if I'm in the equity markets, I'm taking on that tail risk anyway. And so I think that's been a positive response that we've seen from some folks, where they don't necessarily think of it as a negative.
I think it's interesting because taking into account that you mentioned, right? It's interesting how not only RIAs but even institutionals can use these as one single ticker to actually get that exposure, right? How do you think that they will fit this AutoCallable ETF into their portfolio?
Yeah, anyone looking for income is looking to use this type of solution, especially tax advantaged income. A lot of questions are coming in, like, how did you get that high coupon? Like, why is it so stable? So that's opening doors for a lot of the conversations. A lot of people aren't familiar with vol control. It's been around for 30 years, but it's just getting new to the financial advisory community. So I know I'm blanking on what your actual question was. I was going off on a tangent. What was the
It's
question?
how you're going to fit it in a portfolio,
Oh,
right?
yes, thank you.
For
Yeah, so
RIAs and institutionals.
appreciate it. So we're seeing people swap out of their equity exposure to get that high income, especially as maybe they're entering retirement or if they're just looking to generate income from their wealth. Some are looking at it as a high yield bond replacement, not apples to apples, but trading off default and duration risk for equity market risk is a complement there. It's a differentiated risk factor. And then if you hit a market like the global financial crisis, you think you've got some defaults on your high yield bonds. Well, you might have some defaults on your auto callables, not from the credit risk perspective, but just from knocking in or losing some of your principal there. So I think there's some correlation there, but that's essentially the two ways we're seeing people use these.
Okay, so let's talk about this. Matt, we've been, as I said, probably not nicely that we're becoming old because we've been in this industry for 20 years.
I just cut all my
Sometimes I
hair off,
feel,
so it makes me look a little younger.
yeah, that's true. That's true.
You should try
Thankfully,
it.
I have, yes. Now, my wife wouldn't allow it. If you think about if we're both still here, right, in this industry in 5 years, what do you think it's the base case for structured investments? Doesn't matter, ETFs, annuities, securities.
That's a great question. I think that we've just scratched the surface. In the ETF world, I've been in the ETF space for about 22 years. We had gotten our exemptive relief from a large asset manager who essentially told us we don't think there's any room for growth in ETFs. The Qs were taken, the SPY was taken, Dow Jones was taken, and they thought the ETF market was tapped out, no more room for growth. Obviously they were incorrect. We built out the smart beta ETF space. I've been hearing, is there any more room for growth every year for the last 22 years? And just new doors keep opening. There's new avenues to deliver things in a transparent, liquid, tax efficient way. And so I think from, if you broaden out across ETFs and you go to other wrappers, that are including structured outcomes. I think there's going to be a massive growth into this type of space. The 60/40 portfolio kind of came about from Harry Markowitz's paper in 1952. Didn't really hit financial advisory practices, the idea of 60/40, until the late 80s, early 90s, a little before my time. But that's when it started to come about. And then you started seeing structured products, enter the market. And it took about 30 years for the 60/40 model to become mainstream. Now we're starting to see the structured model become mainstream. You all are ahead of the curve above United States, because in Europe and Asia, the way I view it is a lot of families invest their wealth and have their wealth managed by banks. That's largely where you would go. In the United States, it's the investment advisor. And so the investment advisor did not previously have access to the same bank products that you might have as you go to your bank. And it makes sense that you would get structured exposure from your bank. As that space starts to grow, that model portfolio, or that portfolio allocation, is moving from 60/40 more towards a structured type solution, maybe 50/30/20 or something like that. So we are actively seeing that shift. It's a massive shift, and I think we've only seen the very beginnings of it. I think it's a multi-trillion-dollar market if we're here 10 years from now.
I can't say much because I know a few projects that are happening in the US, and I can't tell much about it. So let's change. I want this also to be fun,
You're
right, for
teasing
you,
us,
Matt?
Tiago.
No, 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 no. I really can't. But I have a lightning round. What is it? I ask you a couple of questions. You be honest, right? That's the idea of it. You don't
Okay.
have time to think, okay? And you need to be completely honest, okay? So,
Okay.
are you ready?
Sure.
Okay. Structured products trend that no one is talking about, and why?
I think we just built one. I think we built the start of a trend. I think you're going to see auto-callables come to market a lot more efficiently. I think that's going to be a big trend. Just speaking for the States, tax efficient income is going to be big. Covered call space has grown tremendously, $115 billion. Most of that income is tax inefficient. So I think making sure the income is tax efficient is going to be top of.
Okay. Now, next one. This is not easy. What feature you wish ETFs could implement today that they don't have?
The feature that I wish existed is more of a regulatory process. What I don't like is having to build in public. So if you have an idea, you have to do a registration statement with the Securities Exchange Commission, and you file that registration statement, and then you have 75 days to bring that product out. Well, what that does is it tells all your competitors what you're working on, and it gives them 75 days to figure it out. So if there's anything I would change, it would be that. I think it would be more beneficial to the end investor if competition happened a little bit more behind the curtains, and then they brought products to light. And that would give the ETF issuers a little bit more of an edge to bring out their best ideas. And I think that would be good to change.
Okay. Okay. That's very interesting. So, what's more important for you, distribution or product idea?
Oh, those are hand in glove. It's hard to sell a bad idea, and if you don't have distribution, a good idea can die on the hill. The first iteration of an auto-callable in an ETF was actually built in 2009. I don't know if he's listening, but there was a guy that built a reverse convertible ETF, and it did not make it. It didn't do well, but the concept was there. I mean, it was way ahead of its time, but no distribution, and it didn't last. And then you go 18 what is it, 2025, several years later, and now you've got this auto-callable experience. You're partnering with the banks. I think we're doing it in the right way. This is the product innovation that was needed, but you tie that to a distribution force like Calamos has, and I think we'll be in good shape.
So, Auto-Callables, are they misunderstood or misused?
Those are both negatives, so I think probably both. I think there's a lot of people that probably misunderstand them, and some people probably don't use them appropriately if they misunderstand them. I think that probably goes together as well. The flip side is what we try to do is encourage people to get up to speed. We've told advisors, like, don't buy this until you're comfortable. Like, you need to understand what you own, and it's our job to educate you and your clients. And so we are on those calls all day long with advisors, educating them about what auto-callables are if they don't know. And if they do know, we're educating them about the reference index and walking them through the benefits of laddering that out 52 times inside of an ETF wrapper. So we're trying to change both of those.
Okay, thank you, Matt. I think this was very, very interesting. We try to keep this short, so less than half an hour, just so we can keep our listeners listening to both of us. Yeah, I'm not sure. Is there anything else in terms of what you're doing at Calamo or that you see in the industry that you really would like to talk and be honest about this? Because this is an open forum, right? I ask you some difficult questions. So I think it's only honest and fair that you have your chance to ask anything.
Tiago, where do you see the space going? Like what's selling well in Europe and where do you see this going? That's my question for you.
Like, I think derivatives business is growing massively, not only on equities, also in other asset classes like fixed income, interest rates, CMS, issuer callables. There is a massive growth in commodities with accumulators in Asian accumulators to hedge FX risk, right? Because some people didn't thought, well, actually accumulators and some derivatives actually helps agricultures hedging the risk.
Yeah.
I think ultimately it's growing extremely well. The last 5 years, thankfully, we didn't have any massive blow up from the usual suspects. In any industry, there's always a few that try to take advantage of a product or a name. So I think overall, it's very, very positive. Even regulators are becoming more consistent that actually, you know what, it's fair. They actually have less compliance on these asset class and other asset classes. So overall, it's very, very positive in terms of trends, expansion to asset classes. Because let's think about it, right? It's even if you to get exposure to the S&P 500 or a specific smart beta, or you have a ETF that kind of has similar exposure, right? But on the structured investments, you can get close to Delta One exposure. And I think it's yeah, I think I'm very optimistic. I think these we're talking about the right things. You know, growing asset classes, growing the different wrappers. I think it's a very exciting moment. But I've also seen too often this failing because there was a blow up of someone who sold the wrong product to the wrong person. And I think hopefully that's what I tried to do with this podcast. I mean, and you couldn't be here today, but it's like try to open, have these conversations, and highlighting the risks before it happens. Yeah, but overall, very, 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 very exciting. And I think what you're doing with the ETF wrapper, I think it's very, very interesting. Very, very interesting, especially as you said, right, is to attract institutional investors, RIAs that too tired or don't have the time to choose, right? To choose each note. And I think that's quite exciting.
I do too. Yeah, appreciate the time.
Right. Thank you, Matt. And thank you, everyone, for listening. Don't forget to like, subscribe. Please do it because that will help us a lot. Get people from Matt, like Matt, into the podcast. So thank you.